Well, hello everybody. Good morning. It's about 8:15 in the morning here, and it's Black Friday. It's November 25th, 2022. What I'm going to be basing my video on today is, I guess, more education than analysis. I'm going to be looking at interest rates. So before I get into all of this, as you know, this is not financial advice. I'm not your financial advisor. You're responsible for your own trades and managing your own risk, doing your own research, which I hope is exactly what you're doing right now. And yeah, so what I'm going to do here is go ahead and just kind of take a look. I was watching a video from Alessio a couple days ago, and it sparked some interest in myself. So what I do, and what I hope that you are doing as well, is taking a look at these interest rates. And everybody's talking about the Fed pivot. I mean, literally everybody is talking about the Fed pivot. What I want to do here, hopefully, is provide a little bit of a little bit of information, just purely based on facts and the history. Not trying to predict the future so much as to more just analyze what happened in the past. So what I'd like to do, I'd like to start all the way back in actually in the roaring 20s. So back in the 20s, there wasn't the effective rate as we have today, but there are different measurements that we had back then, and I want to talk a little bit about those. So here is the best data that we currently have right now based on the Fed rates. So looking at this, we have this orange line, which is our Fed funds rate. It was an increase in the late 20s. And then we kind of capped out right around here, which if you kind of follow the crosshairs down, we kind of peaked and kind of flattened in around September of 1929. And it just so happens that that was the top of the market, or very close to it. Let me just change this so you can see it a little bit better. That was really close to the top of the market there in September, October 1929. And what happened there, I think we all know, we had the massive market crash. The market dropped a significant amount. It dropped like 83%, at least in 1929, all the way into 1932. So that took a long time for that to occur. It was, it was devastating for a lot of people. But from there, we had, of course, a massive rally into the 50s. So I wanted to point this out moving forward, that, the Fed, they kind of plateaued rates, or they capped rates to a certain degree, and then eventually they pivoted and started moving rates down. And that's when, of course, things had already started to drop. But the key here is rates were going up before there was any kind of pivot, and the market was going up along with that. There was a rally that went into there, and that's something that Robert Prechter and Alessio have also been mentioning as well. So, but there was really no discussion on what happened in the Great Depression. So I wanted to point that out, that there is some confluence here in late 1929 that also was maybe not the direct result of, but it was at the time when rates were being capped and dropping. And I'm going to talk about that here in just a little bit as well. So I'm going to go over here and I'm going to take a look at this. I'm going to get my my chart that I've got over here, kind of pull it down so that we can see this over here. Because I want to take a look and see what happened in 1957, 59, and 1960. So we have something here that is also not exactly what, really what some of these analysts are suggesting is going to happen. So let's just take a look at October 1957. So if we take a look at 1957, we're moving forward here, and then we get to 1957. So rates got cut right here, right after the market had already dropped. So the market, if we take a look here, the market had already dropped roughly 16%. It didn't drop much more after that. So even if I take this and I go ahead and put the candlesticks back on here, you can see that that rates were cut kind of at the bottom of this. Okay, so again, that's right around here where rates were cut, right? So this is our first time with the federal funds effective rate where the rates were cut. Okay. The next time where rates were capped, okay, so I think this is also kind of a key. Rates were capped in December of 1959. So that was roughly right here. So rates were capped, and then the market, the next month staged a pretty big drawdown, okay? And I think this is going to be a key as to not when the Fed pivots, but when the Fed caps rates. So we, of course, had a rally into when the rates were capped, right? And then after rates were capped, we had a big drop. Okay, then we had a little bit of a rally, and then we had the rates that got cut, right? So this again happened in May 1960. Then we had a little bit more of a drop. Now, this was all in the middle of a correction, and if you've been following me for any amount of time, you know that I follow Elliott wave theory pretty closely, and this looks like a pretty simple correction, but rates were capped at the top of a corrective move, and then they were cut at the top of the next corrective move. So both of these in 1959 and 1960, both of these were before a larger move down, okay? But then I also want to make no mistake that in 1957, when rates were cut, the market had already corrected completely. And, if you were looking at this as, okay, well, rates were cut, so I think we're going to continue moving down. Well, I think you have to take a look at what part of the cycle did that occur. Was it at the end of a red month or at the end of a green month? And I think that's going to be the determining factor on what's going to happen in the future. So Fed makes a massive rate decision in October 1957 at the bottom of a downward move. What happened the next month, it actually was green. And then of course that started a bottom, and that's it had a big move up. Whereas in 1959, in December 1959, the market had already rallied, right? And that's a decent rally here. For 3 solid months, it was rallying. And that's when the Fed decided to cap rates. And then what ended up happening? We went through 4 months of downward pressure. Then we had 2 months of green pressure. And then what ended up happening? They cut rates. And then what ended up happening there? We had a few months of negative movement in the market. Okay. Now let's go into August of 1969. What did we have in August of 1969? So that's going to be right here. We had the Feds that capped rates, and then they cut rates right through here, right? And when this happened, of course, the market had already started to move down, right? And that's when the Feds were kind of capping rates, but then they cut rates after a little bit of a rally happened in the market. And we're looking at these in terms of every one of these candles is 1 month, so it's a significant amount of time. So the market had dropped. Let's just go ahead and measure it. The market had dropped about 18%. The market had dropped there. Then it had a bit of a rally. So from the bottom going up to the top right here, we had the market that went up about 10%. And that's when the Feds decided to cut rates. And after they did that, right, this is again in 1969, the market dropped another 29%. So that's quite interesting. So the market was in a downtrend and it had a rally. And that's when the Feds decided to cut rates. Because fact of the matter is the Fed is going to cut rates based upon a lot of economic indications that they look for. And when they believe that the market is starting to recover, then they're going to start cutting rates to make money more inexpensive to obtain, which really allows more money to flow into the markets. But from a stock market perspective, that play has already played out. So again, you have this news release where the Fed is going to be cutting rates. Well, market makers have already kind of taken that move, and then the Fed cuts rates, and then we have a bigger move down. And again, that same thing happened in 1973. And in 1973, again, we had a little bit of a rally here. And then they said, okay, well, we're starting to see a little bit of a recovery. Things are starting to look better. We're going to go ahead and cut rates. And then we had a big move down. And then the Fed eventually at that point said, okay, we're going to cut rates even more here. And then, of course, had another move down after that. And that is evidenced right here, where this is that first September 1973. And then the second July of 1974 was up here. So we had, a peak. and then we actually had a higher peak right here as the market was continuing to go down, and that, of course, was evidenced by more capitulation in the market before we eventually did start to see a recovery. And, as everybody has already been pointing out, 1980 was a little bit different, right? 1980 was quite different, where we did have a major rate cut, and this was in 1981. So let me point this out over here. Let me just kind of move this over here so we can see 1981. So that was the top of our rate cycle right here. So these rate cuts right here were the highest interest rates that we have seen since then. And from there, when that happened, when the Fed made the final rate cut here, this is also where we saw, again, about 23% downturn in the market. Now, that was a massive rate cut, right? So that was, again, right here at the peak. And then, of course, we had our drawdown in the market all the way until August of 1982. Fast forward to 1989 and 1990. Well, this one was quite interesting to me. In 1989 and 1990, we had a rate cut right here, and then we had another rate cut right here. But the interesting thing about these is in 1989, when we cut rates, the market continued to rally. And then here in October of 1990, we had another rate cut. This was at the bottom of a major correction, and then we rallied off of that. Now, what's the difference between these? Well, I think there is a big difference. When we had this downturn here in interest rates, right, looking at this, this was just a simple recovery off of the interest rate bottom here at about 6% or so. And then, we eventually got to the point where we were down to about 3% in the early 90s. And I think this is where we have to start paying attention again, because we started to see a nice bottom here, right? We had a bottom in interest rates, and then interest rates started to go up again. So I want to focus again now on the late 90s. So we're talking like 1999. So let's pull this over here, and just take a look at this, because again, a lot of us lived through this, so a lot of us can kind of speak to what happened during this time in the cycle. So again, in August of 2000, so that's going to be right here in the chart for the effective rates, we had rates plateaued. Okay, not pivot, but rates plateaued, and as soon as rates got capped, then the market started a major downturn. And eventually they cut rates, and that was in December of 2000. So from the point where they capped rates, which was almost the very top of the market, to the point where they cut rates, the market had dropped about 14%. And after the market dropped 14%, after they decided to cut rates, not just cap rates, the market dropped another 41%. So let's now take a look and see what happened in 2006. Okay, so in September of 2006, rate cap. Once again, we had a rate cap in September of 2006. And then, of course, the market rallied off of that. And then in August of 2007, what happened? Well, we had a rate cut in August of 2007. And of course, that was, again, the top of the market. Let me put this up here. And we rallied for maybe 1 month. But then, of course, we had a massive 56% or so drop in the market. And then finally, last but not least, in most recent history, we have what is occurring today. And what we've got here is we have in January of 2019, after a major green move in the market rallied almost 8% in January of 2019, the Fed decided to cap rates. Okay, so we capped rates. The market was kind of moving up based on that. It wasn't a massive rally like we saw back here, right? When we saw where the rates got capped here, we had a good move up here in the market. But in 2019, we were just kind of maybe moving sideways a little bit, and then eventually we cut rates, and we had a massive rally off of that. But we all knew what happened in COVID. There's a lot of things that occur behind the scenes that aren't related to interest rates, but we can see how interest rates can kind of give you an idea of what's going to happen in the market in the future. All right, and then we have what we currently have is our rates were raised, right? This has occurred in March of 2021. So interesting thing about March of 2021, we had, two really solid negative months. We had negative 5.26%, then in minus 3.14%, not including the downside that was absorbed. But then we had an increase in the market. It rose about 3.58%. And that's when the Fed decided, hey, we're going to go ahead and start raising rates. Now, I say that keyword, start raising rates, because rates are continuing to rise. And we are higher than we were back here in 2019, where we capped rates in January of 2019, right? So what happens if we cap rates? Well, there is a good chance that the market will rally off of a rate cap going into 2023. And what I'm trying to do here is just to look and see what happened in the past. So again, we had a little bit of a downturn here. We had an increase in the market, which we have seen this last month and a half, almost 2 months now. We have an increase in the market, and there is a chance that the Fed will cap rates. Now, if the Fed caps rates down here, I think there's a chance that we will rally. If the Fed decides that they want to just go ahead and pivot here, not cap, but cut interest rates, well, then I think that we could potentially see something that we saw back in 2000, 2001, or 2008, 2009. It really depends on what they decide, and I'm only basing this off of what has happened in the past. Again, if we see, we've had a major downturn here, and we've seen a little bit of a rally, and this is a little more exaggerated than what we're currently seeing now. But if we see a rate cap, chances are we're going to continue grinding up until we cut rates, and then we see the massive move down. I think the key here is the difference between a cap and a cut. If we do see an actual pivot and they say we're going to start reducing rates, well, then I think what we are going to be seeing in the market is probably going to look, a little bit like this. But if the Fed says that we're going to cap rates, well, then I think potentially what's going to be happening is the market is going to rally. Is it going to make a new high? That is, that's completely, that's a game that people try to predict the future. Nobody can predict the future, but what we can do is try and make educational decisions based on the facts that we have seen play out in the past. And what I've tried to do here is I've tried to take a look at every major market move that is related to interest rates that are being capped or cut. I did not look at rate hikes except for 2022. Everything I looked at here and presented to you was when the market or the Fed rather cut interest rates or capped interest rates, because I think that is the scenario that everybody is focused on right now. I think if they continue to increase rates, then I think we're going to continue moving down, at least for the short term, going into 2023. But if they cap rates, I think we're going to continue moving higher. I think if they cut rates, we're going to be in a longer term downtrend. And I think if they continue rising rates, we're going to continue this downtrend at least for a little bit longer. But also, remember, one last thing before I end this. If the Fed decides that they want to continue to raise rates, what I expect to happen, and my mouse is acting a little weird here right now, but what I expect to happen is if they do decide they're going to continue to raise rates, probably we're going to see a big move down in December, January, and then we're going to start to see a really decent recovery. Okay, and this is going to go for probably a few months, maybe even longer than we're expecting. And this, again, is just a hypothesis. This is not a prediction. It's not meant to be a prediction of any kind. It's just what I think might happen. So if they say right here, hey, we're going to raise rates. And again, this is my hypothesis. Right? If they say we're going to raise rates, the market more than likely is going to go down. And then again, it's probably going to last a month or two. And then from down here, nothing is really going to happen. And people are going to just continue to say the market is going to keep going down, down, down. But the Fed isn't going to cap or cut rates until it thinks that a recovery is being made. And so due to that, I think that potentially in December, rates, maybe we're going to continue raising rates, right? They're not going to cut rates or cap rates until they think a recovery is well underway. And I think there's a lot of things globally that are occurring that would kind of negate, the theory that any of that is really on the horizon right now. So chances are pretty good, but right, we won't know until next week what's going to happen with rates. But if they continue to raise rates, I believe the market is going to have a sharp move down, because I think everybody is expecting the Fed to pivot right now. And I think the bets have been made that the Fed is going to pivot. And again, if they don't pivot, and if they don't plateau, and if they just raise rates continually, right? And there's nothing saying that they're going to cap rates or that they're going to cut rates, because, fact of the matter is, we saw rates as high as like 18% in the 80s. We haven't seen anything like that, not even in 2008. But we're seeing higher rates than we have right now, lower rates than we saw in 2008. So we're not in an area of unprecedented territory for us to continue to raise rates a little bit. So if they do that, I do think the market's going to come down. And I think we're going to create a major bottom here, at least for 4 to 6 month period of time. Then we're going to see a rally. When that rally occurs, we have to wait to see what the Fed says. Right? So again, hypothesis here. I think the Fed is probably going to cut rates. I don't think they're going to plateau. I think they're going to cut. And it could be a significant cut. If that happens, then I think that what everybody is expecting to happen will finally happen. But I think it's going to, again, I think it's going to take time for that to happen. We're talking years, right? So this is more than likely what I believe is going to happen. But again, I'm not trying to make a prediction. I'm just trying to look based on the past, trying to take a look and see what could occur in the future if it is based on facts of the past. So if we plateau rates, I think the market will rally. If we cut rates, I think the market will drop. And if we continue raising rates, I think that's going to continue the short-term downtrend. And I think it all really depends on what the Fed thinks is key. But of course, interest rates, that's just one factor in the whole cycle. I'm not going to talk about the dollar index right now. I'm not going to talk about global events. I'm not going to talk about war. I'm not going to talk about COVID or anything like that in this video. But all of those will play a factor into what happens in the future as well. But this is just a key scenario based off of solely interest rates and what the Fed does and how it has impacted markets historically. Right now, we are in a very news-driven market. Just simple news will move the market significantly. And I think that that's kind of a dangerous state to be in, because in 2020, in 2019, everybody was talking about how all these companies were overvalued. And now here we are, the market's actually higher than we were back then. But then you've got a lot of these companies like Facebook, Meta, you've got Tesla, and all of these jumbo stocks that control the market that still have a long ways down to go before they kind of get down to the norm. So we just have to be very cautious as we get into the next few years, because I think we do have some turbulence ahead. I think we have been living in a really, really euphoric market even since 2009. And what we've seen this year, and as you can see, this is just a little blip on the scale when it's very, very possible that sometime in the future, and we will have this in the future at some point, right? I'm not saying it's going to happen in the next 2-3 years, but sometime in the next, 30, 40 years, we're going to have a major, major move down in the market. And we have to see that as a major buying opportunity, especially if you're in the younger crowd, because these pullbacks in the market are really great entry points for young money, new money, to be invested in companies longer term. Okay, guys, that's what I've got for you right now. This was a video that is very different from some of the videos that I've done in the past, from most of the videos that I do. So hopefully this was helpful. If this was helpful in any way, shape, or form, you know the deal. Like, subscribe, share, all that good stuff. And if you need access to our Discord, you can find all of that information on BitDoctor.org. We have options trading, stock trading, educational content. We discuss Elliott wave theory. We talk about Fibonacci. We talk about wave cycles and all of that. And last but not least, wherever you are in the world, I hope you're having a good day, a good night, and a good evening. Take care, everyone.